Assalamu alaikum friends. Welcome to question number 33 of SBR revision kit. This is also a question from your September 2018. Okay. Skizer. So this question is we have intangible assets, we have some conceptual framework, right? We have a lot of tricky areas in this question. That's why I thought of covering this question, and I was getting a request from one of my students to do this question. So on demand, I'm doing this question. So we have stakes in development projects. Okay, we'll be just skimming through the subheadings first before I actually read the whole case study. Then we have development project, sale of development project. Okay, then we have the requirements. So let us read the requirements. This is a 25 marks question, and this is from your section B. Okay, first requirement is outline the criteria in IS 38 for the recognition of an intangible asset and discuss whether they are consistent with the conceptual framework or not. Guys, you need to remember one thing. It's not enough that you just know the recognition of the measurement criteria under a specific standard. You need to know how the definition of or the recognition criteria is consistent with the conceptual framework's definition of assets, liability, income, expense, equity. You should know that because definitely you will be asked questions on this, whether it is consistent or not, whether it is not consistent. Some standards are consistent, some are not. Okay, it's worth 5 marks. There are two requirements if you can clearly see. First part is for writing the criteria for the recognition of intangible assets. Second one is for the consistency with the conceptual framework. So you can divide the marks. It's 2 or 3 or 3 or 2. Okay, I would say 2 marks for recognition and 3 marks for consistency with conceptual framework, giving you 5 marks. You always need to decide how many points you're actually going to write based on your marks. If there are two requirements, you divide the marks equally. Okay. Second, discuss the implications for Skizer's financial statements for both the years. For both 2 years, you have to show the implications, 2007 and 2008. If the recognition criteria in IS 38 for an intangible asset were met, that means it is recognized as an intangible asset, were met as regards the stakes in the development projects above. That means they are linking this to the development projects. If it is recognized as an intangible asset, what is the impact on the 2007 and 2008 financial statements? Your answer should also briefly consider the implications if the recognition criteria were not met. See, first you have to say if it's met, what's the implications on both the financial years, and then if the recognition criteria is not met. Third, discuss whether the process of the sale of development projects above should be treated as a revenue or not in the financial statements for the year ended 31st August 2008. Nowhere you will see that they refer to a specific standard. Some, like for this case, they have clearly told, okay, IS 38, so we know. But what about this one? They didn't mention. You need to know which standard to apply. Okay, and B, there's a separate paragraph just for B, and this is about integrated reporting framework. Guys, you should never underestimate the importance of this. It's not only the your IAS, IFRS, and conceptual framework. You also should know the other things. For example, ratios you should learn. Integrated framework you should know. What are the contents? What are the guiding principles? I definitely didn't cover my lecture on it because I'm doing this. I was going to do this question later after I finish all the sections, all the lectures, but it was on demand, so I thought of doing this. But definitely, I'm going to cover that integrated reporting framework also soon. And also other social and environmental reporting and all you should know. This also will be tested in SBR. So here also we have two requirements. Okay, but definitely, okay, let us go. Discuss the potential issues which investors may have accounting for different types of intangible assets acquired in a business combination. Second, so you need to discuss all these three, and for all these three, the marks are 7. Okay, it is spread. This 7 marks is allocated against all these three. Second, the choice of accounting policy of cost or evaluation models allowed under IS 38. Third, capitalization of development expenditure. So this question is more like intangible assets, right? It's very much lean towards IS 38. That means you heavily should know IS 38 to answer this question very well. Next is discuss whether integrated reporting can enhance the current reporting requirements for intangible assets. So you need to link your integrated reporting knowledge with your intangible assets knowledge for 4 marks only. That means you need to write 4 points. Okay. So let us now go to this. Now I'm going to read the case study. Okay. Skizer is a pharmaceutical company which develops new products with other pharmaceutical companies that have the appropriate production facilities. Stakes in development projects. When Skizer acquires a stake in development project, it makes an initial payment to other pharmaceutical company. It then makes a series of further stage payments. Until the product development is complete and it has been approved by the authorities. In the financial statements for the year ended 31st August 2007, Skizer has treated the different stakes in the development projects as separate intangible assets because of the anticipated future economic benefits relating to Skizer's ownership of the product rights. However, in the year to 31st August 2008, the directors of Skizer decided that all such intangible assets were to be expensed as research and development cost. So, can you understand what's happening in the scenario? 31st August 2007, they recorded intangible assets, but 31st August 2008, now they are recording the intangible assets as expense, as they were unsure as to whether the payment should have been initially recognized as intangible assets. They are not sure about the payment, whether it should be intangible assets or not. So this write-off was to be treated as a change in the accounting estimate. There is another standard for this, okay, when there's a change in accounting estimate. It's IS 8. Okay, sale of development projects. On 1st September 2006, Skizer acquired a development project as part of a business combination. So this came as a part of a business combination. That means when they have acquired a subsidiary, they have also acquired a development project along with it, and correctly recognized the project as an intangible asset on 1st September 2006. However, in financial statements to 31st August 2007, Skizer recognized an impairment loss for the full amount of the intangible asset because of the uncertainty surrounding the completion of the project. They were not certain whether the project will be completed or not. During the year ended 31st August 2008, the directors of Skizer judged that it could not complete the project on its own and could not find a suitable entity to jointly develop it. There is no suitable entity also. Thus, Skizer decided to sell the project, including all the rights to the future development. Skizer succeeded in selling the project, and as a project had a nil carrying value, it treated the sale proceed as revenue in financial statements. The directors of Skizer argued that IFRS 15 states that revenue should be recognized when control is passed at a point in time. Right? When do we recognize revenue? When the control is passed to the customer at a point in time. The directors of Skizer argued that the sale of the right was part of their business model, and that control of the project had passed to the purchaser. That means the buyer. Okay. The B's case study will read later after we finish A, because it is not linked with A. It's all about your integrated reporting and all. So outline the criteria in IS 38 for recognition and whether this is consistent with conceptual framework. You first need to list out the recognition criteria for IS 38. I hope you remember it. But before that, let us go through some key answer tips. This is from your examiner. Conceptual framework is a very important topic in SBR. You cannot expect a question where conceptual framework is not asked. It will be asked in your question 4 mostly, 3 or 4. But mostly it comes in your last question, question number 4. You need to learn its content. For example, the recognition, measurement, disclosure for conceptual framework. For all the 5 elements, what are they? Assets, liability, income, expense, equity. Mostly the assets and liability part. The rest all is easy. Also practicing applying it to, you need to apply this to individual IFRS and IS standard. The SBR syllabus also requires you to discuss the current framework for integrated reporting, including objectives. That means you have to discuss this. The objectives of integrated reporting, what are the concepts, what are the guiding principles, what are the content of an integrated reporting. Do not neglect this popular exam topic. Okay, that means you have to learn integrated reporting. Now let us go to the main answer. Focus on the main answer. You need to write a subheading, which is because there are 2 requirements for A. So you need to write clear subheadings for what you are dealing. Now you are just dealing with the recognition criteria of under IS 38. Okay. Let us see what the tutorial note says. You should know that the recognition criteria in all of the examinable IFRS and IS standards. This is core knowledge. You should know the recognition criteria under all the standards. This is a core knowledge. They definitely will ask this area. For example, under IS 16, IS 38, IFRS 9, all recognition criteria you should know. And intangible asset is one of the I think is very favorite topic of the examiner. They always keep asking recognition criteria of IS 38. So this is the definition of intangible assets. IS 38 defines an intangible asset as a non-monetary asset without physical substance. It requires an entity to recognize an intangible asset if these 2 things are satisfied. So these 2 are the recognition criteria. What are they? It is probable that expected future economic benefits will flow to the entity and the cost of the asset can be measured reliably. But be very careful. This requirement applies where an intangible asset is acquired externally or generated internally. So this you can apply to if you have bought the asset from someone outsider or you have generated that internally within your business, the intangible asset. For example, goodwill or the brand. The brand you didn't acquire is from somewhere else. Okay, you have created your own brand, that is known as internally generated intangible asset. Intangible asset, you can either bring it out from someone, you purchase it out, or you generally intend. So for both of this type of intangible assets, you can apply the 2 requirements. This requirement criteria applies to both of these intangible assets. So the probability of future economic benefit must be based on reasonable and supportable assumptions about conditions which will exist over the life of the asset. Okay, you need to talk about this probability part. Okay, whenever you're asked this, because the first definition is probable, so you need to talk about the probability of future economic benefits. So they are saying that this must be based on reasonable and supportable assumptions. You just cannot say, okay, there's a probability that you are going to receive cash inflow from having that asset. No. Is it based on some reasonable or supportable assumptions you have to say that, okay, you're receiving cash by holding that intangible asset? If yes, then okay. About which conditions which will exist over the life of the asset. The probability recognition criteria, you need to mention about this. Okay. The probability, because based on probability you are recognizing, this is one of the criteria. So the probability recognition criteria is always considered to be satisfied for intangible assets which are acquired separately or in a business combination. You need to write this specifically. You need to write this. We are not talking about the internally generated good intangible assets. We are talking for those assets which you are buying it exclusively from someone else or in a business combination. When you have purchased a subsidiary, from there you are buying getting the intangible assets of them. So for that, yes, definitely you are going to get, it's very probable that you are going to get the benefit of those intangible assets. So the probability recognition criteria is always considered satisfied. That means they will satisfy this criteria. But what happens if the recognition criteria are not met? Remember they told if it's not met, then also you need to write. That also leave one space and write in a separate paragraph, not together. Okay, so if the recognition criteria are not met, IS 38 requires expenditure to be expensed when it is incurred. Then you don't write intangible asset, then you expense it. So that's the first part of the first requirement we answered. Now we are moving on towards the conceptual framework. Consistency with the conceptual framework, the second requirement. Okay. So now, if you see the current definition of assets and liabilities, they make no reference to the probability, but IS 38 was based on probability that you're recognizing assets, intangible asset. Okay. So how do you answer this part? You start referring it to the conceptual framework. This is your starting point. Okay. So according to conceptual framework, items are only recognized. They are only recognized if they meet the definition of an element. That means element means asset, liability, income, expense, equity. These are the 5 elements. Okay. Make sure that you know these 5 elements of conceptual framework. So whenever they say element, it is out of this one of the 5 elements. Only if they meet the definition according to conceptual framework only you can recognize. What is the definition of an asset? You should know this. Okay, you should know the definition of an asset and liability according to under the conceptual framework. That also the revised one, the latest conceptual framework, not the 2015 one. Okay, so the definition of an asset, it is given in bold already. A present, that means you need to memorize it as it is, because these words are very important. You need to write these words in your answer. A present economic resource which is controlled by an entity as a result of the past event. You need to control that resource currently because of some past event. What was the past event? You bought it from your subsidiary or you bought it exclusively, the intangible asset. So past event was the transaction, you bought it. Now you are controlling it because of that. So that is an asset. Definition of an asset. This para and all you don't need to write, okay? This does not mean that all items meeting the definition of an element are recognized. It does not mean that if it meets the definition, it will be recognized. Why? You need to write that as well. An element is only recognized if recognition provides users with useful knowledge. Okay? If it provides users with useful financial information, make sure that you write this word useful information or useful financial information. Because then we are going to towards the 2 characteristics which makes information useful. So in other words, recognition must provide, you need to write these 2 words. One is relevant information. One, it should be faithful representation of asset or a liability. And from that, whatever the resulting income or expense or equity movements. For example, let's say an element, okay, an item is the definition of an element according to conceptual framework. It means the definition of an asset, but you don't recognize it. If the information is not relevant, you feel the information is not relevant for the users, and also you feel it's not a faithful representation of the asset. Then you don't recognize. Okay, so it needs to meet these 2 criteria. After it is recognized, then only you recognize it. Recognition might not provide relevant information if there is an uncertainty over the existence of the element. So for example, wherever you have some uncertainty, then if you recognize it, it's not considered to be relevant information. Okay, uncertainty over the existence of the element, whether it exists also or not, or if there's a low probability of an inflow or an outflow, that you are going to receive cash or you have to pay cash, the probability is very low. So recognition of an element might not provide a faithful representation. Let's say you recognize, but it might not be a faithful representation when there's a very high degree of measurement uncertainty. Okay, so now we are moving towards the, so now we have discussed the conceptual frameworks also. Now the consistency between IS38 and conceptual framework, consistency, the third subheading. As can be seen, the recognition criteria in the conceptual framework and IS38 are different, isn't it? One is basing the recognition criteria on the probability, the other one is not. This is because the recognition criteria in IS38 were based on the previous versions of conceptual framework. You see, the standards recognition criteria for each standard, they are not updated. They are based on the previous version of conceptual framework, but only the conceptual framework is updated. That's why there's a difference. They were not updated to 2018 conceptual framework. They are still following the 2015 version of conceptual framework's definition of assets and liability in the standards. But in the future, they might revise this. Okay. Now, but both IS38 and conceptual framework, what do they do? Their attempt is to ensure that financial statements provide information that meets the qualitative characteristics of useful information, but do this in a different ways. That means they both want it to be relevant, they both want it to be a faithful representation, but the ways are different. How? IS38 uses practical filter of probability and reliability to exclude information that will not be useful. They are basing it on reliability and probability. In contrast, what's happening to the conceptual framework? They refer directly to the qualitative characteristics. They think about relevance and faithful representation, provides guidance on how to apply them. But you need to remember this, that conceptual framework does not override IS38. You cannot override the principles of IS38. The conceptual framework is only applied by the preparers of financial statements when no standard is there, applies to a particular transaction. So the transactions involving intangible assets fall within the scope of IS38, and so the recognition criteria will be according to IS38 only. Okay, this will be applied. Next, implications if recognition criteria were met. Now we are talking about the implication, the second requirement. Okay, so you start by saying that Skizer should have assessed whether the recognition criteria in IS38 were met at the time the entity capitalized the intangible asset. The first time when they capitalized, when they recognized intangible assets, at that day they should have assessed whether the recognition criteria according to IS38 were met or not. This is the first line you need to write. That if the recognition criteria were met, then it was not appropriate to de-recognize the intangible asset. Once it is met, you cannot de-recognize the intangible asset next year. So according to IS38, an intangible asset should be de-recognized only on disposal. When you're disposing that intangible assets, you de-recognize, or when there are no future economic benefits expected from that asset anymore. Right? You are not expecting any future economic benefits either from using it or selling it. That time you de-recognize the intangible asset, or when you're selling it. Other than that, you do not de-recognize intangible asset. Next, if there were any doubts regarding the recoverability of the intangible asset, okay, because they were talking about doubts and all most of the time, the uncertainty, doubts and all. If there are doubts, then Skizer should have assessed whether the intangible assets would be impaired. You have to talk about impairment because they have talked something about impairment around. The next thing after intangible assets recognition is the impairment of intangible assets. Okay, you need to assess for this. When there is a doubt regarding recoverability, when this word is there, then automatically you have to know that they are talking about impairment. You need to link this with impairment. So which standard? For that we have separate standard, IS36. Not just intangible assets but impairment of all assets, this is there under IS36 only. Okay. So IS 36 used to determine whether an intangible asset is impaired. Next, we need to talk about further the reclassification of intangible asset. We reclassified it to research and development cost. So that the further reclassification of intangible asset to research and development cost does not constitute a change in accounting estimate. We need to talk about what they have told, that when you are changing it from intangible assets to research and development cost, it is known as a change in accounting estimate. Is it? No, it's not. It is not. You should very clearly know what is a change in accounting estimate to answer this thing. And that comes from your IS 8. IS 8 knowledge. Right? Change in accounting estimate, change in accounting policy, and error. So they state, so now you need to bring out what IS 8 says about accounting estimate. What is an accounting estimate? A change in accounting estimate is an adjustment of the carrying amount of an asset or a liability or related expense resulting from reassessing the expected future benefits and obligations associated with that asset or liability. This is as it is. They are giving the definition of a accounting estimate. The cost of the stakes in the development projects can be determined and will not have been estimated. Okay. Accounting estimate. So estimate means when you have to estimate something, but when you can determine something, you are not estimating it. Okay. The cost of the stakes in the development projects. You need to link this always with the cost of the development projects. You have to come back or always link to the case study. Here they can be determined and they will not have been estimated. You are not estimating. You can determine the cost. So you are not applying IS 8 here because it is not a change in accounting estimate. Now, you see, this is the second subheading they are using. Implications if recognition criteria were not met. So first you write if it's met, then you write not met. Okay. If it is believed that transactions were never met the recognition criteria in IS 38, then Skizer would have to recognize retrospectively a correction of an error in accordance with IS 8. Okay. What is meaning of retrospectively? They have to go back in the past and change the figure. That is the meaning of retrospectively. When it is prospectively, you don't change the past figure, you change the current and the future figures. Make sure that you know the difference between these two. Retrospectively and protest. Okay, prospectively. When it's a correction of an error, you go back and change that in the past because it's an error, and that is also dealt with under IS 8. If it was not met, then it's an error. If this was not recognized, implications if recognition criteria were not met, because you have already recognized an intangible asset. Now you need to correct that error. It's an error. So now we are moving towards the next one, whether it is recognized as a revenue or not. Sale of intangible. Revenue is defined in IFRS 15 as income arising from the company's ordinary activities. Okay, there is no indication that Skizer's business model is to sell the development projects. They don't say that. So Skizer's business model is to jointly develop a product. That was their business model. Remember, they told they were not getting anyone to jointly develop the product. That shows their business model is to jointly develop a product. Then leave the the production to the partners. So moreover, if the asset was sold in the ordinary course of a business, then it would have been classified on acquisition as inventory. It will be classified as an acquisition as an inventory because it's an asset for sale. Inventory is asset for sale only. In the ordinary course of business, that's what we do. We held inventory to sell. So it's known as asset for sale in the ordinary course of business. So in this case, if this was also like that, asset held for sale, then it will be classified as inventory. Okay, acquisition as inventory. So Skizer recognized an intangible asset and fully impaired the asset. So this is, they are talking about intangible, whether you can recognize this as a revenue or not. But this is already recognized in part A as intangible asset. So you have to fully impair the asset also. So it cannot argue that it has thereafter been held for sale in the ordinary course of business. That means even if you are selling this intangible assets, it is not being sold because in the ordinary course of business. Okay. Furthermore, IS 38 prohibits presenting the process from the disposal of an intangible asset as a revenue. You cannot say. They prohibit that when you're disposing an intangible asset, you cannot recognize it as a revenue. Okay. Next. B. Issues with intangible assets acquired in a business combination. If you have acquired in a business combination and intangible assets, what is it? Remember, this is a tricky requirement, okay? But you're not expected to answer in the same level as detailed as the model answer below. 7 separate points across the 3 issues would be sufficient to score the full marks. Please understand. Across the 3 points, if you write 7 points, you will get the full marks. Definitely, this answer is longer than you are expected to write. So, first one is issues with intangible assets. Next one is issues with choice in accounting policy. And the third one was capitalization of development expenditure. And finally, we have integrated reporting for 4 marks. Which standard are you using for business combination? It is IFRS 3. Okay, so under IFRS 3, acquired intangible assets must be recognized, number one, and measured at fair value. You always have to measure at fair value. Any asset you acquire under business combination, whether tangible, whether intangible, measure at fair value. If they are separable or arise from other contractual rights. Once recognized, IS 38 requires intangible assets with finite lives to be amortized over their useful life, and intangible assets with indefinite lives, they are subject to annual impairment review in accordance with IS 36. You need to write both. If it has finite life versus if it has indefinite life. Okay. However, it is unlikely that all intangible assets acquired in a business combinations will be homogeneous. Homogeneous means similar. And investors may feel that there are different types of intangible assets which may be acquired. So for example, a patent may only last for a finite period of time. Okay, you can give some examples if it's not there in the case study. Examples of intangible assets, different types of intangible assets. So patent may last for a finite period of time. That means for 4 years, 5 years, and they may be thought as having an indefinite future revenue stream. They might last for this one, but they may be thought, okay, you might thought that having an indefinable future revenue stream. That means revenue keeps on coming forever for patent. In this case, what should you do? Amortization of the patent would be logical in this case, right? Remember, what is the topic again? Let me start with it. It is about issues. Issues means problems when you acquire intangible assets. So when you acquire intangible asset in a business combination, that means when you are buying a subsidiary, with the subsidiary, their intangible asset is also yours now. So it's not just one type of intangible assets. Some are finite, some are indefinite. All types of intangible assets comes. Okay, that's why we are talking about one having indefinite life versus one having finite life. So in this case, if you amortize it, it would be logical. I'm sorry. This is identifiable. I read it like indefinite future revenue stream. Identifiable. That means you can identify that, okay, for 5 years, this is the revenue you are getting. So in that case, because it has a finite period of life, amortization is logical. However, there are other intangible assets which are gradually replaced by the purchasing entity's own intangible assets. Okay, you have bought an intangible asset, but now you're replacing it with your own intangible assets. internally generated intangible assets. For example, customer list. And it may make sense to account for this assets within goodwill. So in such case, investors may wish to reverse the amortization. If it is your internally generated intangible assets, right? Can you amortize it? No, you cannot amortize it. In that case, what should you do? You have to reverse the amortization. Investors may wish to reverse the amortization. In order to decide whether an amortization charge makes sense, investors require greater detail about the nature of the identified intangible assets. You should know the nature of the identified intangible assets that you have acquired in a business combination to know whether it should be amortized or not. Because you have not been told anything about the useful life, whether it is indefinite or finite. So if nothing is there in the case study, you are free, you are open to write like this, that more details are required on these things to decide and all. Okay. IFRS standards do not permit a different accounting treatment for this distinction. You cannot use different accounting treatment for this distinction. IFRS standards do not permit you that. Okay. For example, once you are recognizing amortization, you cannot reverse your amortization again. You cannot use different accounting treatment. Now the second one, issues with choice in accounting policy. Okay. So that means when you are giving choices in the accounting policy, for example, depreciation method, straight line or reducing balance method, or cost value versus fair value model. If you're giving options like that, what are the issues? What are the problems? So now you're talking about those issues. Okay. So IS 38, they require an entity to choose either. You're linking everything with IS 38 only. Okay. Cost model, because under IS 38, either we can go by the cost model or the revaluation model for each class of intangible asset. So under the cost model, after initial recognition, intangible assets, you are writing it. If it's cost model, how do you recognizing it? So intangible assets should be carried at cost less accumulated amortization and impairment loss. Correct? Under revaluation model, intangible assets may be carried at a revalued amount based on fair value, less subsequent amortization and impairment loss. Okay, all those things are easy because these are your knowledge only from textbook. The revaluation model can only be used if there's an active market. This is an issue. Problem. You cannot use the revaluation model just because they are giving you a choice. You have to see whether there is an active market for your intangible assets or not. If such active markets are not common for intangible assets, then you have to use cost model. Then cost model. The reported figures for intangible assets such as trademarks may be understated when compared to their fair values. If you see the cost of trademarks, they are less than their fair value. Okay. Moreover, the ability to choose the revaluation model or the cost model may limit. Another issue is comparability. It's hard to compare. Some standards are using cost model, some standards are using revaluation model. How do you compare between them? Now the third one is capitalization of development expenditure. Remember, research expenditure are always expensed. But development expenditure, you can capitalize it also, you can expense it also. But certain criteria needs to be met if you have to capitalize the development expenditure. Okay. In real life, the distinction between research and development may not be clear cut. Moreover, performance related bonuses or stock market pressure may be incentives to classify them as development, research expenditure as development. Okay. So, okay. Let us go through this. If you just write 2 or 3 points under this, it depends on how many points you have wrote previously. Let's say you have wrote, this is 7 marks, right? So you are writing 2 points for this issues with intangible assets and 2 points for issues with choice and accounting policy. So you're left with only 3 marks for the balance. 3 marks can go for this capitalization of development expenditure. So that means you need to write 3 points. You can write 3 separate paragraphs to write the 3 points. Definitely this answer is longer than you can expect. So you don't have to break your head to write so much. Just stick to the point and write the number of points for per mark. IS 38 requires all research cost to be expensed. This is very clear. But when development cost comes, this must be capitalized if technical and commercial feasibility of the asset for a sale or a use has been established. The asset is technically and commercially feasible. Commercially means you can sell it at whatever the location or whatever the condition the asset is today. You can sell it. That is known as commercial feasibility. So we are not going to talk much about research here. We are going to build our points on development cost. Because research there is no issue. It is expensed only. But development only has an issue. So we are going to talk more about the development cost. If an entity cannot distinguish the research phase of an internal project to create an intangible asset for the development, sometimes it's hard to distinguish between research and development phase, especially when it's an internal project, when you are internally building intangible assets. Then what should you do? The entity treats the expenditure for that project as if it were incurred in the research phase only. Even the development phase, they will take it as a research phase in that case. This cautious approach ensures that assets are not overstated. That's why they're very careful. They're extra cautious about it. That's why they're putting everything in research. So the problem for investor is that companies do not have a consistent approach to capitalization. It is often unclear from disclosure, okay, how research expenditure was distinguished from development. It's hard to get it from the disclosure also, how these two are distinguished. It may be that entities allow bias to impact their decision making in this area. Can happen, right? Wherever you can hide something easily or it is not understood well by the investors. Some areas are a little bit complicated like that. It's easy for them to entities to be biased on those areas. Okay. Next, intangible assets disclosure can help analysts understand the innovation capacity of the business. Investors can use the disclosure to identify companies with valuable development cost assets. Once this launch in the market, they should generate economic benefit, potentially increasing investment returns. However, preparers of financial statements are failing to adequately comply with the disclosure requirements of IS 38, which limits their usefulness. Even though users want it, preparers are not willing to disclose it. So there is an issue with that, which limits the usefulness. That's an issue. Okay. Now we are going to the last requirement for 4 marks, which talks about integrated reporting. Before that, we need to read the case study for that. External disclosure of information on intangible asset is useful only insofar as it is understood and it is relevant to investors. It appears that investors are increasingly interested and understand disclosure relating to intangibles. Okay, so they have used this also for these 3 parts, which we didn't read. Okay, a concern is that due to the nature of IFRS disclosure requirements, investors may feel that information disclosed has limited usefulness, thereby making comparisons harder. Many companies spend a huge amount of capital on intangible investment. Okay, which is mainly developed within the company and thus may not be reported. Often it is not obvious that intangibles can be valued or even separately identified for accounting purpose. Integrated reporting framework can be one way to solve this problem. So the requirement is asking you how they can enhance the current reporting requirement. That means we are having some issues, right, with the current reporting requirements for intangible assets. Now, if we are adopting integrated reporting, how it can help? So you can give 4 points, 4 ways how it can help. Okay, so this way, this is an open-ended question. You can answer in any way. There's no fixed way that you have to write like this only, answer this way only. That's why it becomes a little harder also. Open-ended questions are more harder than close-ended questions because there's no fixed format. There's no standard way of writing. So measure the contribution of intangible assets to future cash flow is fundamental to integrated reporting. How much intangible asset is contributing to the future cash flow? It's very fundamental into integrated reporting. This helps explain the gap between the carrying amount of an entity's net asset and its market equity value. You can understand the gap also between the net asset and the market equity value. As set out above, organizations are required to recognize intangible assets acquired in a business combination. So consequently, the intangible assets are only measured once for this purpose. However, organizations are likely to go further in their integrated reporting. Here they are showing only once for the reporting purpose, but in the integrated reporting, okay, and they disclose the impact on the intangible assets as a result of they are going more in detail in the integrated reporting, such as they are showing the impact on intangible assets as a result of sustainable growth strategy or specific initiatives. All these are not known through financial reporting. These are known in integrated reporting because these are some non-financial indicators. It is therefore very useful to communicate the value of intangible assets in an integrated report. So for example, an entity may decide to disclose its assessment of the increase in brand value. How much its brand value has increased, all these things will not be known from your financial reporting. These are known in your integrated reporting as a result of a corporate social responsibility initiative. How will you know what is the impact of CSR initiative on your brand value? Through integrated reporting. So that said, we have completed question number 33. Now let us go to the marking scheme. It's very important. So 5 marks for recognition criteria. That means 5 separate points. Second one, derecognition criteria and impairment 2 marks. Reclassification and estimates another 2 mark. If criteria not met 1 mark. Second one, business model 2 marks. Application of IFRS 15 another 2 mark. And here 3 marks for different types of intangibles. That means internally generated versus acquired in a business combination. Cost or evaluation 2 marks. Because you are giving choices, no? For intangible assets, what are the issues? Next is development or research 2 marks. This one, measurement of financial statements 2 marks, and discussion whether IR can supplement financial statement. That means they can provide more information than what is provided in the financial statements. For that 2 marks. Now let us go through the examiner's comment. It's very important. What candidates are supposed to do? They should discuss the consistency of the conceptual framework with each IFRS. Okay, if you see first part of A, it's a very good illustration on how you will be actually asked in the exam. And generally, students are weak in this area, weak in general. So this shows that you should study more on this area. Okay, answers to second part of A is also weak. That means if recognition criteria is met, if it's not met, what is the implication? They are weak in this area. Okay. Very few identify that we need an impairment review under IS 38. Why? Because it's an asset. Whether it's a tangible or intangible, we need an impairment review. Most of you, they forget this. Okay. Why they are talking about impairment review? Because they told that there are doubts over recoverability from the intangible assets. So definitely you have to talk about impairment review. It's an indicator that there's an impairment, external indicator. Next, for part B, that is talking about issues and integrated reporting. This is good. Generally, it's good. For example, where accounting choices, cost and fair value model. This is better explained. Okay, and also some subjective aspect of IS 38 and IFRS 3. But some they did not consider both the standard. That's why their marks are limited. And last part where we have to talk about integrated reporting, whether it will enhance the reporting for intangible assets or not. Many students, they are familiar with integrated reporting. They know, okay, this is the content, these are the benefits. But very few they applied it to the situation. Situation means IS 38, intangible assets. Okay, so that's it for question 33, and see you in next question.